let's talk about something that might seem like it's happening a world away, but could have a very real impact right in your wallet. We're going to break down how a military conflict in the Persian Gulf is sending economic shockwaves around the globe, and it all starts with the price of oil.
And this quote right here, it really nails it. Iran is a choke point story. We're going to unpack what that means, because it's the key to this whole thing. It's all about geography, about control, and about a mind-boggling amount of the world's energy flowing through one very, very narrow waterway.
So what kicked all this off? The trigger was the confirmation that the United States has launched major combat operations in Iran. And look, this wasn't just a minor incident. This was the development that put the entire global market on red alert over the weekend.
Now here's what's so fascinating about this. Think about who reacted first. It wasn't governments issuing statements. It wasn't the stock markets. They weren't even open yet. Nope. The first responders of the financial world were the insurers. It just shows you how fast risk gets priced into our economy.
And boy, did they move fast. War risk insurers did something pretty unusual. They took action over the weekend. This wasn't a let's wait and see kind of deal. They saw a fundamental, immediate shift in the risk for any ship even thinking about heading into the Gulf.
The chain reaction was just incredibly quick. You can see how it went down. The conflict starts, and almost instantly, bam, insurers start issuing cancellation notices for any existing policies. This isn't just a price increase. This is like hitting the pause button to completely reevaluate the danger, and it sets the stage for costs to skyrocket.
And how much are we talking? Premiums could jump by as much as 50%. I mean, a 50% hike, basically overnight. That is a massive number, and it's a huge signal of just how seriously the market is taking this potential disruption.
So, why this huge reaction? Why does a conflict in this one spot have such an enormous global impact? Well, it all comes down to geography. It comes down to a very specific place that's like an oil superhighway for the entire planet, that strategic choke point we mentioned at the start.
So what exactly is a choke point? It's pretty much what it sounds like. It's a narrow channel, a bottleneck, that is absolutely critical to global trade. If you disrupt it, you can jam up the flow of goods for, well, the entire world.
And the choke point at the absolute center of this whole story is the Strait of Hormuz. This one narrow strip of water is the only way in or out of the Persian Gulf by sea, and its importance to the world's energy supply, you just can't overstate it.
Just try to get your head around this number. 20 million barrels of oil every single day. That's not an annual figure. That's the daily traffic. It's a colossal amount of energy, and all of it has to squeeze through this one little passage.
So, to put that 20 million barrels in perspective, it means a full 1/5, 20%, of all the crude oil that's shipped by sea anywhere in the world passes through this one strait. When you realize that 20% of a critical resource depends on one waterway staying open, you start to get why everyone is so nervous. Okay, so we've got the risk, we've got the geography. Now let's get to the question that affects all of us. What could this actually do to the price of oil and, the price we pay at the pump? All right, so analysts are gaming out a few different ways this could go. Last Friday, a barrel of Brent crude was sitting around $73. Now, in a best-case scenario where this is short and contained, we'll probably see a spike of $5 to $10. But if this turns into a sustained disruption, prices could surge past $90 a barrel.
And this chart really paints the picture, doesn't it? That gap between where we were on Friday and that potential high of over $90, that is a serious jump. It would be a major shock to the energy market, and those shocks are felt everywhere.
So what does oil at $90 a barrel mean for you and me? It means the price at the pump, which was recently averaging just under $3 a gallon in the US, would almost certainly shoot well above $3. This is exactly where geopolitics becomes a real kitchen table issue.
And, of course, the story doesn't end with oil. A shock of this size sends tremors all through the financial markets, as investors basically run for the hills, trying to find somewhere safe to put their money.
Yeah, this is what you'd call a classic risk-off playbook. Oil prices jump, so stock markets are expected to fall because investors hate uncertainty. At the same time, you see money flooding into what are called safe haven assets, things like U.S. government bonds, gold, the Japanese yen, basically anywhere that feels secure in a storm. When you really boil it all down, this whole situation is about one thing: risk, and how, in today's world, uncertainty has kind of become the new certainty. Everything, from shipping insurance to the stock market, is being repriced based on that reality.
And that brings us to the billion-dollar question that every trader, every insurer, every government official is asking right now. Is this a short, contained operation with a temporary price spike, or is this the start of a long, drawn-out conflict that could keep prices painfully high for months? The answer to that question changes everything.
For now, the general thinking seems to be this. The oil will keep flowing. The world is just too dependent on it for everything to grind to a halt. But the big takeaway is crystal clear. The cost of getting that oil safely through the Strait of Hormuz has just gone up. A lot. And that's a price that we're all going to feel.